This week, two industry-leading companies released earnings reports that made headlines. One blew past expectations, the other fell short. Microsoft Bing made a minor mistake, but overall, the company is steadily gaining market share. However, the stock performances of these two companies following their earnings releases were completely different. UnitedHealth initially surged 9% after its earnings report, a massive move, comparable to Tesla launching and delivering a new car model overnight. But those gains did not last. Despite a relatively solid report, deeper problems in the health insurance industry, combined with analyst downgrades, sent the stock into a multi-day decline. In today's video, we will analyze the latest earnings, fundamentals, and future outlook for Microsoft and UnitedHealth. We will discuss whether UnitedHealth can rebound in 2026 and whether Microsoft stock can rise above $400 again. I will also share my fair value estimate for Microsoft. Let's start with Microsoft. Microsoft has once again surpassed Apple in terms of business value, becoming the most valuable company by market capitalization. While Apple remains stuck in a transition period, Microsoft is thriving, benefiting greatly from the artificial intelligence boom, alongside NVIDIA. This quarter's performance was one of the strongest in Microsoft's history. Azure, Microsoft's cloud platform and a key driver of growth, saw revenue increase by 30% year over year, exceeding investor expectations. It was also the first time in several quarters that growth re-accelerated. Microsoft also announced that Azure's trailing 12-month revenue has reached $75.1 billion, signaling strong confidence in its cloud infrastructure. Here are the key financial highlights for Microsoft's second quarter. Revenue reached $76.4 billion, up 8% year over year, beating expectations of $73.8 billion. Operating income grew 20% compared to last year. Azure cloud revenue increased by 30% year over year, surpassing the projected 27.4%. Looking ahead, Microsoft issued strong guidance. Third quarter revenue is expected to reach $75.25 billion, above the market forecast of $74.09 billion. Azure revenue growth is projected at 30.7%, also above expectations. On the earnings call, Chief Executive Officer Satya Nadella stated that supply chain constraints should ease by December, allowing infrastructure investments to keep pace with rising demand. Microsoft is also increasing its capital expenditures significantly. Third quarter capital spending is projected at $30 billion, which is a 50% increase compared to the same period last year. If this trend continues, total capital expenditures in fiscal year 2025 could exceed $120 billion, well above the market's expectation of $100 billion. This suggests that demand for cloud services is much stronger than anticipated, and Microsoft is investing aggressively to meet it. Institutional investors have taken notice. Fund managers have increased Microsoft's portfolio weighting from 11% to 12%, mostly by reallocating away from Apple. Personally, I began adding to Microsoft between August 2024 and April 2025, during the $400 consolidation range. At the time, the growth story was intact, and the valuation was digesting. However, after the recent rally, Microsoft's forward price-to-earnings ratio now stands at 33, and the price-to-earnings-to-growth ratio is at 2.2. That is relatively expensive. A more reasonable PEG ratio would be 1.8, which implies a fair value of approximately $450. If the stock price corrects toward that level, I will consider adding more shares. Otherwise, I will continue dollar-cost averaging on a monthly basis and hold long-term. Investing follows a cycle. There is a sowing period, a growing period, and a harvesting period. Do not chase hot stocks at high valuations. Be patient and wait for pullbacks or management missteps that create buying opportunities. Now, let's shift to UnitedHealth. The biggest challenge for health insurers in 2025 has been the sharp and unexpected rise in healthcare costs. UnitedHealth locked in its premiums and government subsidies back in 2024. As a result, the company is unable to raise prices mid-year to offset the increased costs. Due to regulatory constraints, they cannot adjust Medicare Advantage pricing until 2026. This is a major reason why the entire health insurance sector has struggled. In fact, UnitedHealth's medical loss ratio, or MLR, spiked above 90% in some business areas. Normally, a healthy MLR falls between 80 and 85%. Following the earnings report, several analysts downgraded the stock and cut their price targets. UnitedHealth stock dropped as low as $385 before seeing a slight recovery. The company also revised its full-year guidance. The new earnings per share floor is $16, which is well below the prior lowest analyst estimate of $18. This surprised the market and triggered a 7% drop in a single trading day. Chief Executive Officer Gail Boudreaux admitted during the earnings call that the company mispriced its 2025 Medicare plans by underestimating medical costs by $6.51 billion. To address this, the company plans to raise premiums in 2026, audit billing and crack down on fraud, redesign insurance plans to emphasize managed care, assume 10% medical cost inflation in 2026, up from the previous forecast of 7.5%. However, these adjustments come with trade-offs. The company may cut unprofitable plans, it may reduce its presence in highly regulated markets, it could exit government-run marketplaces if subsidies fall short. These moves could lead to fewer members, increased out-of-pocket costs for patients, and reputational risk. That said, most insurers are expected to follow a similar strategy: raise prices, trim loss-making operations, and wait for healthcare costs to stabilize. Overall, Microsoft remains a high-conviction, long-term investment. However, I do not plan to add more unless the PEG ratio returns to 1.8 or the price consolidates again. UnitedHealth, on the other hand, is in a turnaround phase. Its forward price-to-earnings ratio is just 15, and the PEG ratio is 1.3. That valuation is attractive if the company can return to double-digit earnings growth in 2026. For now, I am keeping UnitedHealth on my watch list. I may consider entering a position if the stock drops to $233 or if it rebounds above $250 with improved third-quarter guidance. Healthcare costs in the United States are rising due to broader macroeconomic and policy-related factors. As a result, patients will likely face higher premiums, fewer coverage options, and greater financial pressure in 2026. While the sector may eventually recover, the path forward will likely be volatile. That concludes today's analysis. If you found this helpful, consider subscribing for more updates and financial breakdowns. Thank you for listening.